But first, I'd like to just talk about what it means to do project management and how earned value management sort of factors in to all of that. So if you think about project management, I mean, you're delivering a project to a customer, and so that project has to be, has a beginning, a middle, and an end. So there's a schedule involved in that, and that schedule involves different activities, tasks, maybe some milestones to say, get this much of the project done by this date, or complete this part of the programming or documentation by this date, and those all drive sort of the plan of delivery that need to happen in the project. But along the way, you're also wanting to understand if you're staying on budget. So budget can be two different types of budgets. One can be hours. So I'm using 10 different people, but I only expect that to be about 10 or 20 hours a person. So you can plan out when those hours are going to be delivered and who's going to deliver those hours. So you get sort of a budget plan of hours, and you tend to know where you are as far as the budget burn, not only by totals to say if I have 20 hours and 10 are burned, I am 50% done with the budget, but you can also plan out when those hours are going to happen. So if as of today I should have burned 10 hours, but I only burned 8, that means it tells a story. That means you're behind schedule on the burn of hours, but you may be on schedule with the delivery, which means you're sort of forecasting an under budget scenario. So those two kind of work hand in hand. The schedule and the budget of hours work hand in hand when you combine them together and use that to have derive some intelligence on how you're doing as far as delivering the project. But there's a third part of it, and that's the financial piece of it, and that's where the cost comes in. So the cost management is something that it's a little more advanced from a project management perspective. Of course, everyone that's doing projects, you're initially scoping out projects with some kind of profitability in mind. So you're considering the types of costs that you're going to incur in the project. But to be able to see if you're going to actually end up after delivery with that same percentage of profitability, you need to be able to predict and track the cost of the resources that you're using and the cost of expenses. And those costs actually could vary quite a bit. So if you were expecting to use a junior associate to do some of the work, but you end up finding that only the senior associates are available, that will hit your project negatively, and you will actually, although get the same revenue perhaps for the project, you may actually come in at a lower profitability because you had to use a more expensive resource. So I think this third piece is important, and the third piece is actually a big part of what earned value management brings. So schedule and budget, that's a pretty common metric. A lot of companies will have their project managers use at least those two measures, but the third measure really adds a lot of another level or another facet to the project management aspect as far as the burn of the project. Now, when you're delivering a project, you need to know from a scheduling perspective what is actually going to be done. So what kind of work am I going to do? When do I have to finish it? And then who's going to actually do the work? Okay. So as you're building out your project plan, you're breaking up the project into probably discrete pieces or activities or tasks to say, here's the activities that I'm going to deliver on this project. Here's when they have to be delivered, maybe throwing a few milestones in there. And here's the kind of resource that I need to do, or the actual resource that I need to do the work. And from there, of course, you plan out not only your task plan, but you plan out your resource plan from a scheduling perspective. From the tasks, you have to be able to put in things like durations. So when does it start? When does it finish? So that drives a duration or a timeline for that task. You should have some milestones in there for key deliverables, like you're going to make sure that you know when you're supposed to deliver this documentation, maybe this developed piece of code, maybe this installed solution. So those all drive what a schedule is going to look like. So it's the what, when, and who components of the schedule. Now you can also group things together logically by phases, for example. So you have phase 1, which is initiation, if you're doing like a standard waterfall type approach. where you have things like project kickoff and requirements gathering and a review of the business model and all of those great things at the start of a project. And you could have a test window, and the test window is identifying testers, coming up with the test cases, executing test 1, revising and executing test 2. Those are all different tasks that you can do in those phases, and you would be able to measure how well you're doing on the delivery of the project and how well you're staying on schedule by understanding if you've completed phases of the project and be able to close those phases out so that you are making good progress and not end up delivering everything at the same time. From a budget management perspective, budget management really factors into different levels depending on the kind of project that you're delivering. At a very high level, the budgets are managed at a project level. So I'm going to deliver this project to this client, and I think it's going to take 100 hours. Okay? Not a lot of intelligence in that statement other than saying it's going to be 100 hours. I don't know who's going to do the work. I don't know what the activities are that they're going to be doing. I don't know the timeline. So that 100 hours is probably something that either I've done based on my best guess or I've, the fact that it's something that we repeatedly do over and over again. Like we deliver report training courses, and the report training courses are a day and a half. So I can say it's going to take 12 hours because I have that knowledge that it's not going to take more or less than that. That's what the course is. So that at a project level, that is one level to be able to do budget management for. But when you start combining it with the schedule activity, now you want to bring that budget down a level to the task. And the task can be, I need to do these 3 things on the project, and the 100 hours is split 60 hours for the first task, 20 hours for the second, 20 hours for the third. So that alone gives you another level of control and another level of measurement when you're managing the project, because just having a number of hours without context doesn't give the project manager a lot of information to go off of to understand if we're on track or not. All they know is that we went over budget or not. If you marry it with a task, the task now can have a schedule, and the tasks themselves can have a budget of hours so that we know, first off, are we going over or under per task, and then are we delivering the hours in the timeline that we expect to deliver. So I definitely recommend customers think about going at least to the task level when they're doing their project management, because that gives the project managers more tools to work with. Now, a more advanced approach is to take it down to the individual person level, and this is going to lead into our EVM discussion. So the individual person level is where you start factoring in the fact of, I have a task, it's going to take 60 hours to complete. However, I need these 5 types of resources on it. This first resource is a senior executive, and I only need 5 hours of that person's time. The next person is a junior associate, and I need 50 hours of that person's time, and I need 1 more hour or so of everyone else, and that totals up to 60 hours. You can see from that perspective that people are given a budget so that they know to sort of stay within that budget. They know what's expected of them, because behind the scenes, most likely, there's been 2 considerations. One, if it's a T&M situation and maybe you have some kind of price list by types of resource, what is the customer expecting to see as a bill? If you're charging out a senior executive at $700 an hour, they certainly don't want that person to do things like updating an Excel document, because that's a kind of a giant waste of money. But they want to understand what that person working in minimal hours is bringing great value, and that's why the rate is what it is. So that's one aspect of it. When you break the hours down per person, it may drive a different billing view from a client perspective. But from a project management view, it also gives the ability to understand, well, if this type of resource is delivering the work, or this particular person is delivering the work, what is the cost of that person to the organization? And that starts factoring into the reason that you priced this project at this rate is because you expect to make this type of profitability, and that profitability is completely being driven by the cost of a resource. So if you can break those hours not down to just the task level, but down to that lower level, that person level, which is much more advanced, and I realize it's a lot more work, it does give you a whole lot of control from a project management perspective on where is the cost going to hit, what types of resources are going to hit, what's the timing for that hit. And now you have multiple ways to look at the project delivery and not only subjectively but objectively be able to look at how the burn is looking from a numbers perspective, both from a schedule and a budget perspective. Okay. So hours budgeted over time give you a project burn plan. So you basically plan out tasks, ideally down to the person level, so you know how many hours, the cost of those hours that are going to be delivered through the lifetime of the project. Milestones technically don't get a budget. Milestones, you either hit the milestone or you don't hit the milestone. Now that's not a universal truth. If you talk to various PSA systems, professional services automation systems, some systems actually use the term milestone as something to capture time against and deliver. You are working to deliver this milestone. They have a different concept of it. But the way that I look at it is you either meet the milestone or you don't meet the milestone. So it's a 0 or 100%, and that's kind of black and white. There's plenty of gray areas if you want to interpret it the other way, but there's tasks and then there's milestones on the project. Now from a cost management perspective, when resources are delivering the work, every hour that they're delivering work, there is a cost associated with it, and then that there's a potentially revenue earning associated with it depending on how you bill your contracts. But really the cost is what I'm going to be focused on from a project management perspective. And as you know, even though people may have the same title in the organization, they may not cost the same in the organization. So there's a lot of variety on what it means to have a cost of a resource. When you're budgeting or planning out your initial project, you're probably using sort of a middle of the road, what's the cost of a junior associate to the company, what's a cost of a senior accountant to the company, and you're using those as a basis to figure out the cost, which is how you're pricing out the engagement and getting your initial budget. But as you start staffing it with real people come with real costs, and so now your junior associate being staffed by a senior accountant is really going to kind of blow your cost budget because they're a much more expensive resource. So as you start getting into named people, the named individuals may have a higher cost simply because they've been with the company longer. They're a more senior person as far as levels are concerned. Maybe they have a different skill set. So we're using a DBA to do technical writing. Why can't we use a writer for that? It all depends on what the needs are of the project and the availability of the resources you have. So cost management is a big thing on schedule management, budget management, and the third factor being cost management on how you can keep all those together to understand where you're at as far as performance on the project. Now, of course, expenses can be factored in, but you'd have to track an expense spending plan. Try to say that 5 times fast. And that expense spending plan is something that you really, the expenses really don't vary other than, if you happen to book airfare within a 2-week window and now it's higher expense than you expected. But expenses are tend to be more predictable. At least you can put controls around them to say you can't spend more than, $50 on dinner when you're in New York. So all of this leads into the concept of earned value management. So earned value management is a management technique that combines those 3 aspects, the budget of hours, the cost of those hours and expenses, and the scheduling across time into these things called performance indices. So there's a schedule performance index, SPI, and there's a cost performance index, SPI. So you can tell already from the names, I'm really focused a lot on understanding cost, and I'm understanding when cost is going to happen. And how each of these are computed, and on the next slide I'm talking about the definition of these terms, but the schedule is how much value have I earned as of today versus how much value did I expect to earn as of today. And value in all of these cases really boils down to numbers. So it's not the subjective completion of work, and I've I'm still working on this document. I think I'm about 50% finished with the document. This is more about money and the spending of money in here. The cost performance index is based on how much have I earned as far as cost how much did I earn as far as cost in the system versus the actual cost that I have in the system so far. Okay, so if I've earned the cost based on my calculation against the actual cost that I've incurred, then I am on track. I've spent the cost that I expected to spend. I've spent the cost that I expected that I planned to earn. And both of these indexes really work around the idea of 1. 1 is utopia. If I can get a CPI of 1 and an SPI of 1, I am on track for cost and I am on track for schedule. If you see it fluctuate over or under 1, that means something's off. And for example, if you have a cost index less than 1, that means you have earned less value than you have as burned as far as cost. You've earned less value than the cost you've incurred, which means you are actually projecting yourself to go over budget. You're spending too much cost to get to that value level. If your CPI is greater than 1, you are projecting to go under budget because you are getting more value for the cost that you have delivered. And similar for the SPI. The SPI, if it's less than 1, that means you have earned less value than what you expected to earn. And that means you're behind schedule, right? So you, from a budgeting perspective, a cost delivery perspective, you have not performed where you expected to. Now, does that mean that you're not completing the work in time? It may not, but according to your plan, you are technically behind schedule because you haven't burned the money. If you're greater than 1, then you are ahead of schedule. So you are looking like you are delivering things faster than you need to. But of course, these two work together in tandem because one doesn't tell the whole story. You have to balance, are you projecting to go under budget but over, you're burning, you're ahead of schedule, then maybe there might be something simple like that's a great story, but you may be missing timesheets, for example, in the system. So these two work together to really give you the full vision of earned value. So here's what all those 3 metrics are. So remember, it's schedule performance index is earned value divided by planned value. So let's talk about what earned value and planned value are. So earned value is actually the percentage of the work that you plan to do that has actually been completed. And then, so this would be down to the individual task level based on the dates and the time frames that you expect to deliver the work. And then you multiply that by the budgeted cost at completion. So you're getting sort of here's your total view of the cost that you expect to burn for the project. And then what percentage have you burned through for the planned work that you had so far. And that gives you an earned value. So that same earned value, that's what you've earned so far because that's how much work you have completed according to the plan. That earned value, the earned value is the most complicated part of earned value management methodology. So equations like that are available on web. They're available in some of the PSA product tools to break this down more, but I have to use the higher level discussion for this webinar. So that's the earned value. Now for scheduling, we have to understand what the planned value are. So the planned value is simply how many hours did we expect to deliver by today and what was the cost of the user in delivering those. And that's my plan. So that's a pretty simple calculation, even on spreadsheets. How many hours did I deliver and what's the cost of those hours based on the users that are doing the work as of today. So taking my earned value, which is how much I've earned, the percentage of the planned work that I actually completed, that divided by planned value gives me where am I at as far as the schedule is concerned. Now the cost index, how much cost have I earned versus the actual cost. The actual cost is very simple, like the planned value is. The total hours multiplied by the cost of the user. So that gives me my cost index. So the most complicated piece of this is the earned value piece, which of course defines earned value management. But once you have defined the earned value, then dividing it by planned value and actual cost can give you your SPI and CPI values. Now there's also other EVM items that you could be wanting to look into and keep an eye on. Things like earned value percent complete. So what is according to the earned value method, what is my percent complete? In many tools, percent complete may be just a cost percent complete, or it could be an hours percent complete, or it could be a number of milestones closed percent complete. But EVM's the definition of percent complete is what is the value that I've earned so far divided by the total cost budgeted for this project. Okay. Now there's also variance items. So this is where you get money values, like how far off am I from my budget? How far off am I from my cost? How far off am I from my schedule? So not only do you get that ratio index with the indices, you get the variance. So what's the difference between what I plan to earn from a budget perspective versus my actual cost so far? What did I expect to earn from a schedule perspective versus what I plan to earn? So these give you money values that you can attribute to looking at the indices, looking at the trending of the indices, and then actually looking at the impact of money involved in that. So you're trending fast, you're trending slow. Okay. In order for you to actually be able to do earned value management for your project, you have to understand the hourly cost of the people who are doing the work. It's a must. Because without that, you really can't get your earned value values. You have to schedule your tasks for a duration. So you can't just say 100 hours to complete this task. You have to have a timeline. Not only is the cost one big factor of earned value, the second big factor is when is that cost going to happen. So those two together give you a basis to do a lot of the calculations. And then finally, what if I meet a milestone? Does a milestone have a value that can contribute to my earned value? Okay. So there is another model that I've seen applied for earned value besides the complexity of the cost and the hours scheduling that has occurred. For the cost and the schedule that we just talked about, that might be too much for your projects. Okay. And if it's too much for your projects, or you want to have an earned value management, but you want to put some definitions around, if the project's over 100,000, we have to do earned value with cost percent complete. But if it's under 100,000, then maybe we can use something that's more of a milestone earning model. Okay. So I call this one and I've heard terms like this before, but it's like a EVM light or EVM, a small EVM, something like that. And really what the process here is, you don't have as much calculation, you don't have as much reliance on resources and costs, but what you do have is you plan out milestones by date. So you expect to finish this work on the 17th, and this work on the 31st, and this work on the 22nd, and each of those milestones may represent an amount of work that needs to be delivered. Think of it in terms of if you were doing a statement of work and your statement of work had payment milestones. Some statement of work with payment milestones may say, you know what, I'm going to break this up into 4 pieces and it's 25% each. But in many cases it'll be, I'm going to break this up into 4 pieces, and the first piece is going to be the most work, so I'm going to have you, I'm going to charge you 50% of the project. And then the second one is going to be light, that's only going to be worth 10%. And then the third one is worth 25%. And now the last one is going to be, I've lost track of what I'm doing, the 10%. Okay, so that you could have varying rates for the payment plan. EVM Lite sort of plays along those lines, where you can say, okay, I'm going to establish these milestones, and as we hit these milestones have a value, and they could be different values along the way. But as you reach a milestone, you actually can say that I earn X dollars of the budget, or X dollars worth of cost for the project as you hit the milestone, right? So that gives you still a cost level, and it still gives you a schedule, but it doesn't have the reliance or the detail related to users in the system, okay, and the cost of users and hours type thing. Similarly, with milestones, you could also have oh geez, it keeps coming up. Similarly, you could also plan out an EVM light for task delivery. So instead of having it be hours and cost of hours, what you could do is you could have the earning of a cost value of the task with earning 50% of it when you start the task and 50% of it when you finish the task. And that simple method there still gives you a level of earning cost, but you don't have to go down to the individual hours by task, by person type calculation. You do a 50-50 earning based on tasks and 100% earning based on milestones. That still gives you enough information to do the math. Like, I plan to hit this much cost. How much did I earn so far based on my 50-50 or 100? And then based on the total dollar value, the total cost value, what percentage cost complete am I based on the earnings of the 50-50 or 100 method? So this is another way to do it, a little bit of a twist on the EVM method that I covered previously. The previous one is the much more robust, detailed resource level cost type thing, but this EVM Lite is actually something that can be done. It's a little easier to calculate, and it does attach itself to the value of a milestone. So the key part of this is understanding how do you put values on milestones, how do you put values on tasks so that the 50-50 and 100 actually makes sense at this point. So that's a little bit about EVM models that I've experienced or worked with in the past. A lot of it is a cost management method that gives you a timeline on delivery and a timeline of earnings so that you can know whether you're burning hot or burning cold and not wait until you're over budget or not wait until you've lost all your profitability because you used really expensive resources. The key to earn value is understanding and defining what those earning rules are. The two different EVMs I talked about, one of the earning rules is all about the cost of the resource and the timeline for delivering hours for the resource. The second one is a simplistic, what's the value of a task and a milestone, and do a 50-50 or 100% earning based on that value. So hours are not even a factor. And of course, if you haven't already invested in one, PSA systems, a lot of these tools can actually calculate EVM for you in a more automated way, so you don't have to pull out that spreadsheet and calculator and try to do it all yourself, because that way you have all of your data pulled together and it can give you more real-time information as we go.
Bye.